If you're earning over $200,000 a year and you still feel frustrated every April, that frustration isn't random. It's not bad luck, and it's definitely not because you forgot one deduction. At that level, tax pain usually signals something deeper because once income crosses certain thresholds, small inefficiencies don't stay small. They multiply year after year, and over time, that drag turns into real capital. But here's the part most people don't see in real time. You don't feel it immediately, you feel it later. 5 years down the road, when you look back and realize how much momentum quietly slipped away. Then it all clicks. You're not overpaying because you missed a write-off, you're overpaying because your income was never designed. And that's a completely different problem. Most six-figure professionals obsess over percentages and brackets. They track their rate, they watch policy changes, they wonder how new legislation might affect them. That's normal, but here's where the deeper issue begins. The tax system isn't built around percentages. It's built around positioning. It rewards how income is structured, not just how much is earned. So if all of your income flows straight into a W-2 paycheck with no intentional design before it ever reaches your return, you're operating reactively. And at that high income level, reactiveness becomes expensive. The order mistake. Strategy happens before income, and this is where the real issue reveals itself. It isn't the tax rate, it's the order in which income is designed. Most high income earners never stop to question that order. They've spent years mastering growth, climbing roles, negotiating compensations, building equity, expanding practices, scaling revenue. They know how to increase earnings. What almost no one stops to ask is this: where is that income positioned before it lands? So here's what usually happens. You focus on earning more, the money hits your paycheck, taxes are withheld automatically, and months later, you sit down with your CPA and you ask, is there anything else we can do? But by that point, the income has already been classified. The structure was decided the moment it hit. That's not a strategy. That's the reaction. And the reaction becomes expensive once your income scales. Most high-income earners move in this sequence. They earn, they get taxed, and then they spend what is remaining. Strategic earners reverse the thinking. They decide where the income should land, they design the path first, then the money follows that architecture. The shift sounds small, but once earnings cross certain thresholds, the math starts behaving very differently. And that's where real separation begins. And this is exactly why that separation compounds over time. The tax system was never designed to treat every dollar the same. It was built to encourage certain behaviors. If you look closely, it rewards activity that expands the economy, building businesses, creating jobs, investing domestically, developing energy and infrastructures. And it does not reward income the same. It rewards production. And that distinction becomes critical once income moves beyond basic earnings into serious wealth building territory. Because salary income is the most straightforward category in the system. The moment it hits your paycheck, it moves through a fixed path. It's withheld, it's reported, and processed automatically. That's very little flexibility, not because employees are targeted, but because the structure itself is simple. Now compare that to income flowing through a legitimate business entity. Even a modest one, when revenue moves through an operating structure, timing can change, so allocations can change. The recognition of income doesn't always mirror straight W-2 compensation. That's not about gaining anything, it's about understanding how the framework actually works. And once earnings cross certain thresholds, that framework matters far more than most professionals expect. Because at higher income levels, tax drag stops feeling like a line item. It becomes a force that compounds whether you pay attention to it or not. Most professionals obsess over market volatility, but steady tax erosion year after year often has a greater long-term impact. It doesn't create headlines. But over a decade, that difference is rarely small. So what does this actually look like in the real world? It's not about writing off your lifestyle, and it's not about stretching definitions. It's about building legitimate economic activity that the tax system already recognizes differently. And most high earners underestimate how small structural shifts can completely change the conversation. Let's take something simple, your home. If your home is purely personal and all of your income is earned somewhere else, there's nothing to discuss. It's for personal use. But when a portion of that home is used exclusively and consistently for legitimate business activities and not occasionally, not casually, but in a defined and regular way, the classification changes. That shift may not feel dramatic, but legally it changes the treatment. And once income flows through a legitimate business structure, new allocation conversations become possible. The same principle applies to vehicles. When people hear write off your car, It sounds like just internet hype, but that's not what it is. If a vehicle is genuinely used for business operations, meeting clients, visiting sites, reviewing investments, that usage can be documented. And when it's documented properly, allocation follows. But notice the order. It doesn't start with the deduction. It starts with the structure. The structure is the gate. Without it, these conversations don't even exist. And once that gate opens, the conversation changes. This is where planning moves beyond surface level deductions. Now we're talking about positioning. Most high earners eventually experience medical costs. For W-2 earners, deduction thresholds are often so high that even meaningful out-of-pocket expenses barely move the number. But when income flows through a properly structured entity, different conversations become possible. Health coverage can be structured differently. Retirement capacity can expand beyond standard employee limits. In some cases, defined benefit plans enter the picture. Not automatically, not for everyone, but when positioned correctly, the framework changes, and that's when perspective widens. Because most high earners are quietly dealing with three pressures at once: capital risk, tax drag, and uncertainty around what they're actually compounding. Let's make it practical. If you're earning $500,000 a year, and after federal tax, state tax, and inflation, what portion is truly building long-term momentum? If your portfolio earns 8%, but 35 to 40% of your income never reaches the compounding stage, you're not compounding effectively. You're climbing uphill. That's where sector-specific incentives begin to matter. Not because they're trendy, but because the tax code incentivizes certain forms of production. Domestic oil and gas is one example of that principle. Provisions like intangible drilling costs and depletion allowances were written to incentivize domestic energy development. In certain structures, that income may be treated differently than standard passive investments. This isn't a recommendation and it's not appropriate for everybody, but it illustrates something important. The tax code rewards behavior it wants to see. And once you understand that, you stop chasing deductions and you start designing positioning. And this is where compliance and strategy begin to separate. If your CPA only reviews what happened last year, but never discusses how income should flow next year, you likely just have compliance. That's not a strategy. That's documentation. Compliance records what has already happened. Strategy decides what happens next. And that distinction becomes expensive once income begins to scale. Now let's clarify something. This isn't about artificial entities. It isn't about zero tax promises. And it's definitely not about aggressive loopholes. That language is unrealistic and often very risky. This is about aligning income with structures that already exist inside the law. The tax code runs thousands of pages because it contains incentives, but incentives don't activate themselves. They require intentional planning, and that planning has to happen before income ever reaches your return. And once you understand that planning has to begin before income ever touches your return, the real shift becomes obvious. It's not about earning more, it's about increasing sophistication in how income flows. Once income crosses certain thresholds, doing nothing carries a lot of cost, not dramatically, but steadily. Most high earners are disciplined in business. They optimize margins, they negotiate compensation, they analyze investments, but very few apply that same level of discipline to how their income is structured. That's the missing pillar, and that's why frustration resurfaces every single April, and it's rarely about the percentage. It's about design. Now, to be clear, this is educational content. It's not tax or financial advice. Every structure must align with your goals, your risk tolerance, and your regulatory environment. But if you're earning a strong income and no one has ever walked you through how your income is structured, that's worth examining, because the objective isn't saving a little this year, it's preserving capital over decades. It's controlling timing, it's embedding efficiency into your financial life, and that's how durable wealth is built. Not through shortcuts, but through structure. If this conversation shifts how you think about income and you're starting to see that your earnings may be reported, not just intentionally designed, the next step is simple. In the description below or in my bio, you're going to find a link to book a one-on-one call with me. On that call, we're going to look at one strategy the ultra wealthy are using that they've been using for decades. This isn't for everyone, but if you're serious about moving from a reactive to an intentional design, that's where the conversation begins. Because at higher income levels, taxes aren't just an expense. They're a design decision, and a design always comes before income.